Good afternoon, everyone. I'm the last presenter. I'm Professor Jo Jung-gun, working at SoCoRI University. I'm the professor of finance, and this paper is regarding intercountry investment, and I focused it into the taxation issue. So there is no model here. There is no research hypothesis here. I present this paper regarding the master limited partnership, which is a part of a form of investment into the infrastructures in the U.S. And this map shows the interstate and the intrastate pipeline structures which carry the natural gases and oils. And this MLP actually investing into these pipelines with a long-term contract, and the outcome will be long-term stable yield to the investors. Okay. The MLP is a different kind of animal, interesting animal in a way, because it works like a corporate. However, it acts like a partnership. So whenever we say partnership taxation, the taxation here means a pass-through, which means the entity level doesn't pay any tax, and then the participants or shareholders or partners will be obligated to pay taxes. Okay, and then the paper here is pretty much summarizing the surveying the latest changes in U.S. taxation, because end of year 2017, so starting year 2018, the new tax law was become effective, and it will be effective until year 2025, which is called Tax Cuts and Jobs Act of 2017. And then owners of this pass-through business will get reduction of their tax payment of 20% up to. The point of this paper is, as a qualified investor registered in Korea, and then if we're investing into the U.S. master limited partnership as a limited partner or as a part of general partner, then what will be the taxation outcomes to us? Okay. That's pretty much the whole theme of this paper. Okay. First, we have I summarized the six specific characters of this MLPs. This is the public traded partnership. So, and then the partnership, as I mentioned before, is a pass-through entity, so it doesn't get paid any tax. Okay, and the participant will be liable for the tax. The second point is, even though there is a taxable income, and whenever there is a depreciation deductions, then the participants will end up paying nothing in some cases. Pretty much front part of this investment phase. Okay. Third one is the losses are pretty much deferred. Okay. Because of this number two effect as well. And the fourth one is taxpayer doesn't owe any tax and distributions, because whenever the investors get paid, and it will be the only part of the distribution will be considered as a return of capital rather than a capital gains. So this is tax free. And the fifth one is they have to calculate the cost basis, which is related to number 4 as well. Okay. Last one is during the holding period of the partnership shares or units, then they will get in the full benefit of tax deferred or tax deductions. However, whenever they sell out or disperse the partnership units, then all the previous benefit will be added up, and then they have to pay it as an ordinary income. Okay. So the structure is effectively deferring the tax burdens to the later years. Okay, and then I concluded three consideration as a potential risk factor. Okay, first one is if we're investing into the U.S. Partnership shares, and then we usually come up with two types of investment vehicles in the U.S. First one is the Delaware Series Limited Liability Company, and then the other one is a Limited Liability Partnership, which is also established in the state of Delaware. In the meantime, this is a problem with the Korean tax authority, because some of the Korean tax authorities they don't regard much for those the newly established Delaware Series LLC, Limited Liability Partnership, the company. Then potentially we have mismatches in identity and residency of the taxable income. Also, in Korea and the U.S. there is a tax convention between the countries, and the investors in Korea will not be able to get full benefit out of this tax convention. This is one big consideration. Second one is the most prevalent form of investing here is investment trust way. The form of investment trust, and the form of investment trust. And in the U.S., investment trust is not quite common. However, in Korea, it's a very common form of that. And the problem of investment trust is so far there was no tax dispute between and among the countries regarding the tax residency and the personality of Korean investment trust. However, the chronic problem of Korean investment trust is it's not a person. Okay? It's not a taxable person. So whenever the other side of the country, the tax officials deny the personality of Korean tax investment trust, then there's no way they can escape that. So my suggestion is it will be much better to structure, instead of an investment trust, as an investment company. The company collective investment vehicle might be much better idea. That's the second conclusion. Third one is a little bit mediocre compared to first and second. Participant of the U.S. Master Limited Partnership will be liable for the Internal Revenue Code Section 1446, the withholding of interest income. So even though we try to structure it in a more efficient way to avoid this withholding. However, my conclusion is there's not much we can do about this withholding structure. So whenever there's something withheld in the territory of the U.S., and you have to pay first, and in Korea we go to National Tax Service to get some part of a refund. The maximum rate is only limited to 14%, which is critically reducing the whole investment return of the participants. So the number three is a little bit of a problem. Oh, this is it. As I mentioned from the beginning, there's no hypothesis, research hypothesis. There's no the research model. This is because about a year ago, the new tax law has been engaged into the investment world, and I pretty much surveyed the implications to this new tax law to Korean investors, especially those qualified Korean investors. Okay? The topic is pretty much outrageous. Is there any question or any general question? Otherwise,